Hello all, welcome to my channel. My name is Prajakta Bapat. Today's video is about ratio analysis and interpretation part 4. In this video, we'll be discussing about efficiency ratios or turnover ratios. This is fourth classification of ratios. In earlier videos, we have discussed first three classifications, that is liquidity ratios, profitability ratios and capital structure ratios. Let us discuss today turnover ratios or efficiency ratios. Now, what do you understand by efficiency ratios? So, it states the efficiency of business, how efficiently business uses the capital or assets in order to increase the efficiency of business. So, first is capital turnover ratio. Now, there is one trick to remember all kind of turnover ratios. Whenever you have any turnover ratio, turnover meaning sales will always be in the numerator. Okay, so this is one trick to remember the formula. So first is capital turnover ratio. Capital turnover meaning we all know capital is amount which is invested into the business and turnover meaning sales. So this shows the relationship between how much amount I have invested and what is the sales of the company for a particular time period. So sales will be numerator upon capital employed, and capital employed will be total of your liability side. Next comes is fixed asset turnover ratio. So as I said, turnover meaning sales will be always in the numerator. So sales upon fixed assets. Fixed asset meaning you have to consider tangible plus intangible assets. Next is debtors turnover ratio. Now this is very important ratio. Debtor turnover meaning, debtors meaning from whom certain amount is receivable. Meaning when you sell certain goods to the customers at a credit period, that is called as debtors. So we get amount later on. These are my assets. Now, in any business would think that they will wish that their debtors time period, their collection time period should be very less. So the early will receive amount, it is good for business, right? So debtors turnover ratio, it counts that how many times this debtors cycle happens. Meaning the answer for debtors turnover ratio is calculated in times. So if your answer is 5 times, meaning 5 times this debtors have happened, meaning that we have sold out goods and then we have received amount from debtors. This has happened 5 times. That is debtor turnover ratio. It indicates that. So maximum number of times, meaning it is good for company. Okay, so now what is the formula? Let us learn the formula. As I said, turnover will be always numerator, but debtors are related to credit sale, because whenever there is credit sale, at that time only debtors arises, debtors or bills receivable. So I have to take numerator as only credit sales. Upon I have to consider average debtor plus average bills receivable. Now what do you understand by average? So I have to consider opening plus closing upon 2, that is average. So average debtors is opening debtors plus closing debtors upon 2. Same for bills receivable as well. But many a times in question they don't provide the information related to opening and closing stock, okay, of debtors or bills receivable. So in that case I have to consider the closing one itself, that is which is given in the balance sheet itself, and then consider this as a average. Assume this as a average. Okay, so answer comes into times. Now next is debtors collection period. Now I want to calculate that what is my debtors collection period. Okay, so meaning how much time period I have, meaning your business has provided to the debtors. What time period, what term has been provided. So formula is average debtors plus average bills receivable upon credit sales. Now if you see, this is just the opposite formula of debtors turnover, meaning your denominator becomes your numerator now and vice versa. Okay, into 12 months or 365 days. So if you want answer in months, it will be multiplied by 12 months. If you want answer in 365 days, it is, you have to consider, meaning if you want in days, you have to consider 365 days. So if your answer comes to suppose 2 months, that means one cycle of debtors get completed after 2 months or 1 month, whatever is your answer. That means within 2 months you get your amount back. You get your debtors encashed. Okay, next circle starts, that is debtor collection period. Now same we will discuss for creditors turnover ratio also. Like debtors meaning from whom amount is receivable, which is your asset, which we have discussed. Now creditors meaning your liability. Okay, so they are basically my suppliers from whom I have purchased certain material or some assets, and I have not paid. At that time your creditors arises. So here also your answer comes into times. Okay, and this is the answer should be lesser one, meaning if your answer is 2 times it is good, meaning you are postponing that payment, right? Meaning you get that much of time to use that cash. So it is always said that debtors time period should be lesser and creditors time period should be more. Okay, so creditors turnover ratio is equal to, now as I said to you that turnover should be always in the numerator, but here creditors are no way related to sales, they are related to purchase, that to credit purchase. So numerator has to be credit purchase upon same like debtors, you have to consider here creditors and bills payable. Okay, so average creditor plus average bills receivable. For average same rule is applicable like debtors itself. And here answer comes to times. So as I said ki if it comes to 2 times, meaning in a year this creditor's cycle goes on, it happens 2 times in a year. Creditors payment period. Now how we calculated debtors collection period? Same way creditors payment period, meaning how many months, within how many months or within how many days we pay off to the creditors, that is creditors payment period. So formula is just opposite to the creditor turnover ratio, that is your denominator comes in numerator, average creditor plus average bills payable upon credit purchase, again into 12 months or into 365 days. So you will get answer either in months or in days. Next is stock turnover ratio. Now what is the meaning of stock turnover ratio? Again here answer comes into times. Okay, so generally what happens that any business or any manufacturing concern, they buy stock at a larger quantity at a time and they keep it in a warehouse, right? And as and when required they use it for the manufacturing, they transfer it to the factory. Now generally whenever there is more demand for goods, this raw material has more movement, right? So it is good for business if their raw material moves quickly and it gets converted into finished goods and it is sold out. So again we can order for the raw material, meaning if there is more movement, it shows that there is more sales for the company, more turnover of the company, right? So the stock turnover ratio, as I said, the answer comes into times. So if it is 5 times, meaning in a year this process of purchasing raw material and getting converted into finished goods happens 5 times in a year. So if it is more, it is good for the company, right? If it is less, it shows that their product has no demand in the market, because they are not purchasing raw material many times and converting it into finished goods. So here now your turnover meaning sales, but in stock we cannot consider sales, no, because stock meaning you are considering manufacturing of goods. So I have to consider cost of goods sold, that is COGS, okay, upon average stock. Now average meaning again opening plus closing stock, which you will get in the question, opening plus closing stock upon 2. Next next ratio is stock to working capital ratio. Now we all know that working capital meaning which considers current asset, difference between current assets and current liabilities, right? And working capital is the amount which we require for day-to-day activities, for daily needs of businesses. Now normally what happens if you buy stock at a bulk quantity and if you don't use it, okay, so it is called as like a dead investment. It blocks your working capital, because what happens if I have purchased stock at a more quantity and if it is not utilized, then my cash is blocked over there, right? Meaning I have bought stock, I have kept it in a warehouse, but I'm not using it also, but I have paid for that, right? So it is wastage of resources. That's why you should not have more percentage of stock in the working capital. Obviously it should not be lesser also, it should be enough quantity, and which changes according to every business. So we have here tried to find out what percentage of stock is there in the working capital, what proportion of stock has in working capital. Okay, so the formula is closing stock upon working capital. Again here it is very easy to remember the formula. Stock to working capital, first is stock which comes in the numerator, just you have to consider closing stock upon working capital into 100, that is stock to working capital ratio. So if your answer comes to 30%, suppose, that means your working capital consists of 30% stock. Only stock has 30% of part in the working capital. So these are the ratios we have discussed for this category, that is efficiency ratios, the turnover ratios. That's it for today. In the next video, we'll be discussing investors ratio, meaning which all ratios are used by investors for evaluating the business decisions, so evaluating the investment decisions. Okay, thank you. If you like my video, please make sure that you share and subscribe. Thank you.